The Aditya Birla Group, of course, and one of its subsidiaries has announced one of the biggest deals in India's renewable energy sector, agreeing to acquire Shell's India renewable business, that's Sprng Energy, in a transaction valued at nearly $1.8 billion.
This is by far one of the biggest ongoing deals in the super active renewable energy segment in India. What we are given to understand from our sources is that the Aditya Birla Group has in fact emerged as the likely frontrunner to acquire Sprng Energy, Pune-based Sprng Energy, which is the clean energy platform of British energy giant Shell PLC in India.
A British oil giant just sold its Indian renewable energy business. An Indian conglomerate just spent 17,200 crore rupees, that's $1.8 billion to buy it. And in one signature, India's clean energy map was redrawn. This isn't just an acquisition, this is a signal about who controls India's energy future and why global oil majors are quietly stepping back from the businesses they once called the future. Let's break it down. Hi, this is Indranil and welcome to the Spotlight Beyond Profession, where you go beyond headlines, beyond borders and beyond the press releases to decode what global capital, policy and power actually mean for you. Today, the Aditya Birla Group's biggest renewable energy bet yet. Here's exactly what happened. Aditya Birla Renewables, a subsidiary of listed giant Grasim Industries, has acquired Solenergi Power, the Mauritius-based holding company of Sprng Energy, in a deal worth rupees 17,200 crore or roughly $1.8 billion. Solenergi's seller, Shell PLC, the British oil major that bought Sprng Energy just 3 years ago from global private equity firm Actis. The numbers matter. Sprng Energy brings a 5 gigawatt renewable portfolio to the table. Combined with Aditya Birla's existing assets, this deal catapults Aditya Birla's renewable to 9.2 gigawatts of generation capacity, instantly placing it among the top tier of India's renewable energy players. Sprng's power is contracted to stable, state-owned counterparties, meaning predictable long-term revenue. Financially, Sprng Energy posted a consolidated turnover of rupees 1,253 crore in financial year 25. This deal didn't happen overnight. Shell launched the sell process last year, mandating Barclays as advisor. By October 2025, reports confirmed the process was underway. By January 2026, Aditya Birla had already been shortlisted as one of 4 contenders. And it wasn't a quiet handshake. Aditya Birla beat out serious global competition like KKR, Actis and the National Investment and Infrastructure Fund, all in the race. Talks moved to a conclusive stage when Shell executives visited India to review Birla's proposal directly and get their approval. To fund it, Aditya Birla is reportedly lining up rupees 15,000 crore in term loans from SBI and Axis Bank. The deal still needs a green light from the Competition Commission of India and the Central Transmission Utility of India and is expected to close by the end of this calendar year. Now, beyond the numbers, here's the story underneath the story. Point 1. Big oil is retreating from renewables, and that's not small news. Shell don't sell Sprng Energy because renewables failed. Reporting suggests Shell's own shareholders pushed the company to refocus on its core oil and gas exploration business. Translate that. Global energy majors are under investors' pressure to prioritize near-term hydrocarbon return over long-horizon green bets. That's a meaningful shift in how global capital is pricing the energy transition right now, and it's a trend worth watching well beyond India. Point 2. Indian conglomerates are stepping into that vacuum with scale, not slogans. This is Aditya Birla Group's biggest single move yet in green energy, and it fits a pattern. Kumar Mangala Birla framed it as strengthening India's energy future and industrial competitiveness, not as an ESG marketing exercise. Aryaman Bikram Birla called it a step towards building a top-tier national renewable platform, merging Sprng's utility-scale assets with Birla's existing commercial and industrial business, which already powers group companies like Grasim, Hindalco, Ultratech and Century Enka, plus state utilities in Gujarat, Karnataka, Maharashtra and Odisha. That's the real ESG story here. Energy security and industrial self-reliance delivered through private capital at a scale that used to require sovereign wealth or big oil balance sheets. Point 3. Governance and financing discipline will decide if this bet pays off. A Rs 15,000 crore debt-funded acquisition is a leverage story as much as a green energy story. Regulatory approvals, integration, execution, and how this debt is serviced will determine whether this becomes a genuine ESG win or simply a scale play dressed in green language. That distinction matters, and it's one we will be watching closely. Zoom out, and this deal fits a global pattern. Western oil majors are recalibrating their green energy exposure under shareholder pressure. Emerging market conglomerates in India, in the Gulf, across Asia are the ones absorbing these assets, often at record scale. Capital for the energy transition isn't disappearing, it's simply changing hands, moving from legacy oil balance sheets to domestic industrial giants with long investment horizons. For India specifically, this deal is a marker. The country's renewable ambitions are no longer dependent on foreign majors staying committed. Homegrown capital at billion-dollar scale is now capable of driving the transition itself. That's a governance and sovereignty story as much as it is an energy story. But it's not the whole story, because every time a foreign owner exits and a domestic buyer steps in, there is a second, quieter narrative running underneath it. Let's go there next. But zoom out one more level, because there's a harder question sitting underneath this deal. Strip away the Indian capital comes of age narrative for a second and look at what actually happened. A foreign investor exited India. Shell, a global strategic investor with deep balance sheets and decade-long horizons, chose to pull its capital out of Indian renewables and redeploy it elsewhere. And this isn't an isolated data point. Over the recent past, India has seen a recurring pattern of foreign strategic and portfolio investors trimming or fully exiting Indian assets across energy, retail, telecom, and financial services, even as headline GDP numbers stay strong. Here's why that matters and why it deserves a neutral, hard look, not just a celebratory one. The financial argument for concern when foreign direct investment exits and is replaced by domestic debt-funded acquisitions like that reported Rs 15,000 crore in bank loans financing this very deal, the transaction adds concentration and leverage risk to India's own banking system rather than bringing in fresh external capital, foreign exchange inflows, or new productive capacity. Critics of this pattern argue that when growth is increasingly funded by domestic leverage rather than new FDI, the quality of GDP growth changes. It reflects asset consolidation and ownership transfer, not necessarily new value creation, new jobs, or new exports capacity. That distinction between growth from expansion versus growth from ownership reshuffling is one economists watch closely when assessing the durability of a country's growth story. Fewer fresh FDI inflows can also mean less pressure supporting the rupee, since FDI is typically considered more stable, long-term capital compared to portfolio flows that can reverse quickly. The geopolitical arguments for concern, a sustained trend of foreign capital preferring to exit rather than double down, can also be read as a signal about global investor confidence in regulatory predictability, ease of doing business, or long-term policy stability. If that signal compounds across sectors, it could narrow India's access to foreign technology transfer, global best practices, and diversified capital pool that typically comes bundled with FDI. Leverage India may want to retain as it competes with other emerging markets like Vietnam, Indonesia, and the Gulf states for the same global capital. There's also a strategic dimension. Who owns critical energy infrastructure, even when the buyer is domestic, matters for how India positions itself in global energy diplomacy and supply chain negotiations. The counter argument, and it's a strong one, others would push back hard on that framing. They would argue this deal is proof of that opposite, that India's domestic private sector has matured enough to absorb billion-dollar strategic assets without needing foreign capital at all, a sign of genuine economic self-reliance, not weakness. Shell's exit, in this view, is a company-specific portfolio decision driven by its own shareholders wanting sharper focus on oil and gas, not a verdict of India's investment climate. And Indian conglomerates raising large domestic debt to fund expansion is exactly how mature economies like the US, Japan, and South Korea built their industrial giants through recycled domestic capital, not permanent dependence on foreign ownership. In this reading, a deep enough domestic capital market that can absorb a $1.8 billion exit without disruption is itself a sign of financial system maturity, not fragility. The honest answer probably sits between both arguments, and that's exactly the debate worth having, not resolving in a thumbnail. So here's the real question, and we want to hear where you stand. Is this deal proof that Indian capital is finally ready to lead the world's energy transition, or is it one more sign that foreign investors are quietly stepping back from India, replaced by domestic debt rather than fresh capital? Does this strengthen India's true GDP growth story or mask a shift in who is actually funding it? Drop your take in the comments. Follow the Spotlight Beyond Profession for the stories that connect policy, capital, and power without the noise. This is the Spotlight Beyond Profession, beyond headlines, beyond borders. Thank you very much for watching and signing it off.